This is Iceland, an isolated, homogeneous island near the Arctic Circle. What many people don't realize is that the global financial crisis of 2008 had its first major victim in this subpolar region. In October 2008, Iceland's three largest banks, Kaupthing, Landsbanki, and Glitnir, were nationalized after they defaulted on $62 billion in foreign debt. Foreign investors fled, the krona plunged by over 50% in a single week, and 95% of the stock market's value was wiped out. Almost all companies filed for bankruptcy as a direct result of the banking collapse. A currency in free fall, banks in ruins, and a desperate appeal to the IMF, Iceland's worst financial crisis in modern history, left the country scarred, shaken, and hard to forget. But how did Iceland's banks end up in this crisis? How did the 2008 financial collapse reshape Iceland's economy, politics, and culture? And what steps were taken to bring the nation back from the brink? At the turn of the 21st century, Iceland enjoyed a strong international reputation and low sovereign debt. With a small population, Icelandic banks turned to international markets and expanded rapidly. This Arctic island, once heavily dependent on fishing, boasted one of the highest qualities of life in the world. But then, privatization initiatives were introduced, altering the relationship between citizens and the state. At the forefront was Prime Minister David Oddsson, whose push for modernization laid the groundwork for the economic collapse. His first major move was the sale of a state-owned fishing company, a decision made possible through support from Iceland's 14 richest and most influential commercial families. Oddsson believed that Iceland needed to diversify beyond fishing and transform itself into a global financial hub. In 1999, Oddsson's first financial sector privatization was the FBA Investment Bank, followed by two major state-owned banks, Landsbanki and Banki. By offering customers higher interest rates abroad than they could earn at home, particularly in the Netherlands and Britain, Iceland's three largest banks expanded to 10 times the size of the national economy by 2003. To attract deposits from the Netherlands and the United Kingdom, the banks offered interest rates as high as 15%. Because the Icelandic krona was strong, they could sustain these returns. In 2004, government restrictions on the mortgage industry were lifted, allowing loans of up to 90% of a property's value. This triggered a surge in housing prices and the formation of a real estate bubble. At the same time, equity refinancing boomed, and consumers began spending on cars, motorcycles, and vacation homes. As the bubble grew, Icelandic banks encouraged clients to invest in their stock. Banks also began aggressively promoting exotic financial products, such as car loans in foreign currencies. They even competed with one another by offering increasingly attractive credit terms. By that time, the global economic outlook had worsened, and so had international confidence in Iceland's banking industry. In 2006, Fitch, a British bond rating agency, raised concerns about Iceland's growing external debt. A Danish bank also issued a warning. Investor confidence shook when the Bank of Japan raised interest rates that same year, prompting many to pull their money out of Iceland. Still, Oddsson dismissed speculation of an impending financial crisis as absurd. There was no doubt Iceland's overheating economy had ignored many red flags. The country had tried to transition too quickly from poverty to prosperity. In an effort to boost their credit ratings, several Icelandic financial institutions launched online banks, attracting new retail customers, primarily from the UK, Germany, and the Netherlands. With interest rates above 6%, they drew in approximately 300,000 British and 125,000 Dutch depositors. And then, on September 15, 2008, the US investment firm Lehman Brothers filed for bankruptcy, and the global credit markets collapsed overnight. It was catastrophic for Iceland's three largest banks, which had relied on massive loans to finance their aggressive international expansion. Suddenly, they had no access to refinancing. The collapse of Kaupthing Bank, Landsbanki, and Glitnir triggered panic across the nation. At the time of their failure, the combined assets of the three banks were 11 times the size of Iceland's GDP, making a government bailout virtually impossible. Due to a lack of resources, the government was unable to save the banks. They were not too big to fail, they were too big to save. As a result, the collapse of these financial institutions brought down the entire Icelandic economy. Global financial markets were stunned by the shockwaves of this single national crisis. Both the economy and banking sector lost all sense of stability and confidence. The krona quickly collapsed by 50%. Because of excessive borrowing in foreign currencies, the liabilities of Icelandic banks soared. Stock prices fell, collateral lost its value, and foreign lenders issued margin calls to Icelandic companies. Investors withdrew from the market and refused to renew credit default swap agreements. Then, on October 8th, Prime Minister Geir Haarde addressed the nation on public television, declaring that Iceland was facing a grave crisis. The speech stunned the population. Many citizens could not comprehend how their country had gone bankrupt. One economist later estimated that the Iceland owed between 20 to 30 billion euros. The average Icelander carried $403,000 in personal debt, and 25% of homeowners were at risk of foreclosure. They had taken out repeated loans, mortgaging everything they had, and in each case, the Icelandic government was ultimately responsible for the debt. As a result, unemployment soared. With the krona's collapse, Icelanders who had borrowed heavily in foreign markets could no longer repay their massive debts. And it did not end there. Amid the chaos, the United Kingdom took a dramatic step. British taxpayers were forced to cover the losses of their citizens who had deposited money into Icelandic banks. In response, the UK government invoked the Anti-Terrorism, Crime and Security Act of 2001, labeling Iceland as a financial threat, essentially equating it with a sponsor of terrorism. This legal move allowed British regulators to freeze Icelandic bank assets in the UK. The Icelandic public was outraged by the comparison to terrorism. After a period of tense diplomacy, both countries reached an agreement on the repayment of British depositors. As the crisis deepened, the numbers became staggering. 85% of Iceland's banking system had collapsed, and more than 50,000 people lost their savings. Frustration hit its peak, and with it, the government also fell. On January 23, 2009, Prime Minister Geir Haarde resigned due to illness and called for early elections. Björgvin Sigurdsson, the Minister of Commerce, also stepped down, citing stress from the economic collapse. But despite everything, Iceland survived. The economy would eventually recover, even after bankruptcy and the fall of its government. So, how did Iceland recover? Well, in the beginning, with the assistance of the IMF, the Icelandic government implemented strict capital controls. These prohibited the export of capital and restricted private citizens from purchasing foreign assets. To help stabilize the economy and repay domestic depositors, the IMF provided a loan of $2.1 billion. This made Iceland the first Western country, after the UK, to receive an IMF bailout. Later, when the government collapsed, the people of Iceland elected Jóhanna Sigurdardóttir and her coalition in February 2009. She barred capital from leaving the country. She raised taxes, but she also maintained social services and offered debt relief to mortgage holders. She banned citizens from buying foreign currency or investing in foreign stocks. As a result, people began investing in local companies, including real estate and private equity. Despite an 11% decline in real wages between 2007 and 2010, the government focused on raising taxes and easing the financial burden on homeowners. A key factor in Iceland's rapid recovery was the sharp fall in the value of the krona. Exports, always a pillar of Iceland's economy, became far more competitive. Labor costs decreased, nominal wages adjusted downward, and unemployment was kept under control. Moreover, Iceland emerged as an attractive, affordable travel destination, thanks again to the weaker currency. Since the financial collapse, and strangely, since the 2010 eruption of a modest volcano that disrupted air traffic across Europe, tourism in Iceland has flourished. And yes, it played a major role in the recovery. By 2017, 2.2 million tourists visited the island, a figure nearly 7 times Iceland's population. Iceland eventually lifted its capital controls, thanks in part to its booming tourism sector. In early 2016, it repaid UK and Dutch depositors with a total of £374 million in compensation. After years of deep recession, the island returned to economic growth, recording a staggering 7.2% GDP growth in 2016, the highest among all OECD countries that year. And Iceland did something else that few other advanced economies dared to do. It jailed its bankers. In February 2016, Iceland sentenced 29 bankers to prison for their roles in the financial crisis. Today, Icelanders are once again on track to becoming some of the richest people in the world. Did we miss something? Share your thoughts in the comments below. And if you found this video informative, Do not forget to like, subscribe, and turn on notifications as we regularly upload insightful content like this. Thank you for watching.